With the Dow down 170, time for our ETF spotlight. Bob Pisani on the floor taking a look at ETF flows in general in the first half, Bob.
Hello, Sarah. ETF flows at the half were strong, but not like 2017. Just take a look. 148 billion flowed into the U.S. ETF business in the first half of the year. That's a respectable 4% increase, but that's a far cry from last year. We had roughly 240 billion in the first 6 months. So the lower inflows are due to that major hiccup in volatility we had in February. But U.S. equity continues to see inflows, 53 billion. That's a respectable number. Investors haven't given up with the love affair with fixed income. This surprises me. 50 billion went into U.S. fixed income, though a large part of that was high yield. They love high yield still, and that's not surprising. The risk in high yield, is not interest rate, it's credit risk, and with the U.S. economy so strong, credit's holding up very well. That makes a lot of sense to me. Inflows are not the hottest topic in the ETF business. It's the fees. They keep dropping. Many platforms offer no commission trading under certain conditions, including Fidelity and Vanguard, but yearly fees also have been dropping. The average ETF fee has dropped at iShares, this is just one example, from 32 basis points in 2013 to 24 basis points in 2017. That's a 25% drop. And by the way, it's even lower if you take a look at Vanguard. Now, even the lower cost index funds are starting to cannibalize each other. So where does this all end? My bet is it's not going to be long before we see a zero-fee ETF, zero. And that's going to be a loss leader that will be used to sell people higher value services. This is great news for the consumers out there, but it's making the consumer investing business a lot tougher. And many big names this year, Federated, Franklin, Legg Mason, they're all down more than 20%. There's Legg Mason, just an example.